Hello and welcome to this Croner eCPD module prepared by Stephen Relf. In this module we will look at the loans to participators rules. In broad terms, the rules impose a tax charge on the company where it makes a loan to a director or a shareholder. As the great majority of companies are close companies, and as it is common for a director or shareholder to be indebted to the company, it is very important that we have a good understanding of these rules. We'll have time to cover only the main points here. Please see your notes for links to the in-depth commentary on all aspects of the rules. We'll begin the presentation by looking at the scope of the rules. This will help you to identify circumstances in which the charge to tax applies. Next, we'll look at how the charge is calculated, including how relief is given when the loan is repaid or released. From there, we'll consider how to deal with the charge in the company's tax return, including how to claim a repayment of any tax paid. Finally, we'll consider the consequences for the company and the participator where the loan is written off. Please note that we will not cover the separate but similar charge on arrangements which confer a benefit on a participator. Again, there is a link to guidance on this in your notes. The rules apply where a close company makes a loan to a certain type of borrower in circumstances where an exception does not apply. The relevant types of borrower are A. An individual, where that individual is either a participator, referred to here as P, in the close company, or is an associate of P. B. A company, where that company receives a loan or advance in a fiduciary or representative company, and is P or an associate of P. C. The trustees of a settlement, where at least one of the trustees or actual or potential beneficiaries is P or an associate of P. And D. A partnership, including an LLP, where at least one of the partners is an individual who is P or an associate of an individual who is P. In the next few slides, we'll look at the meaning of close company, participator and associate, and at what constitutes a loan or advance. We'll also look at the exception for low-value loans to employees, being the exception that is most likely to be abused. Anti-avoidance provisions apply to prevent arrangements being entered into to avoid a charge to tax under the loan to participators rules. These target indirect loans and loans made by a company which is controlled by a close company. These provisions are not considered here. See your notes for a link to the in-depth commentary describing the scope and application of the provisions. In this slide, we'll run through some of the key definitions. Given the time constraints, the focus here is very much on the main points to be aware of. Please see your notes for links to detailed guidance. The main test of close company status is framed around control. A UK resident company is a close company if it is controlled by either 5 or fewer participators or by any number of participators who are directors. The term control is widely drafted and includes where a person has more than 50% of the company's share capital. For the purpose of determining control, a participator is deemed to hold rights and powers held by his or her associates. A person who has a share or interest in the capital or income of the company is a participator in respect of that company. In other words, we are looking at the company's shareholders here. The main category of associate is the participator's relatives, being his or her spouse or civil partner, siblings, parents and grandparents, and children and grandchildren. The rules apply to informal loans in the same way as they do to formal loans. A company may meet personal expenditure of a shareholder director, crediting it to the person's loan account. This arrangement, which is very common with OMBs, is an informal loan, which is within the charge to tax. HMRC's position is that where a person has more than one account, the balances should be considered in isolation. Debit and credit balances should not be netted off. A loan may be made by accident. For example, a dividend could be found to be unlawful, perhaps because the company did not have sufficient distributable reserves to pay it. In such a case, the recipient of the dividend is liable to repay the amount to the company. A debt which arises because the person has bought goods or services from the company on credit will not normally constitute a loan or advance for these purposes, providing the terms of the credit are commercial. HMRC now accept that unpaid share capital does not give rise to a loan for these purposes. The loans to participators rules do not apply where the loan is a low-value loan to an employee or director. To qualify for this exception, all 4 of the conditions set out on the slide must be met. These are as follows. Firstly, the borrower must be a director or employee of the company or of an associated company. Second, the borrower must work full-time for the company or an associated company. HMRC's guidance is that for this purpose, full-time working is not less than 75% of the normal working hours of the company. Third, the borrower must not have a material interest in the company or an associated company. A person has a material interest in the company if they hold 5% or more of its share capital. In determining if this is the case, we must bring in shares held by the person's associates. Finally, the aggregate amount of the loan or advance and any other outstanding loans or advances made to the borrower by the company or an associated company must not exceed £15,000. Let's look at an example to illustrate this point. In this example, a close company has made a number of loans to a participator. The first 3 conditions set out on the previous slide are satisfied, leaving us to consider the final test. Does the total amount borrowed exceed £15,000? The first 3 loans are not within the charge to tax, as on each occasion the aggregate amount owing does not exceed £15,000. At the time the loan of £8,000 is made, the total amount due does exceed £15,000, and so the charge to tax applies with regard to the full £8,000. Having determined that our loan is within the charge to tax, let's look at how to calculate the tax payable under CTA 2010 section 455. Before we get into the nuts and bolts of the calculation as set out on the slide, there are 3 key principles to bear in mind. First, section 455 tax is payable for an accounting period in respect of loans made during that period. Second, relief is given where the participator makes a repayment or where the company decides to write off or release the debt. In this section of the presentation, we'll refer to repayments and releases as repayments. There are some provisions which apply to prevent the abuse of repayments, and we'll look at those on a later slide. Third, the due date for payments and refunds of the tax is 9 months and 1 day after the end of the relevant accounting period. To calculate the tax charge, we must first identify the balance of the loan outstanding at the end of the accounting period in which the loan is made, referred to here as AP1. In so doing, relief is given for repayments made before the end of AP1. We then multiply the balance by 32.5% to give the provisional tax liability for AP1. Next, we deduct from the provisional tax liability the tax value of any repayments made after the end of AP1 and before the due date for AP1. This is the final tax liability for AP1, and it is payable to HMRC by the due date for AP1. Where a repayment is made later than the due date for AP1, relief is given for the tax value of the repayment by way of a refund of the tax paid for AP1. The refund is payable to the company on the due date for the period in which the repayment was made. Let's work through an example. Our client is a close company which prepares its accounts to 31st December. On 1st March 2018, the company made a loan that is within the charge to tax under Section 455. The loan was repaid in 4 tranches, as set out on the slide. The first step is to identify the balance at the end of the accounting period in which the loan was made, being the year ended 31st December 2018. This is £32,000, as shown in red on the slide. The provisional tax liability is therefore £10,400, being 32.5% of this amount. The next step is to claim relief for repayments made after the year end but before the due date. We have a repayment of £6,000, as shown in blue on the slide, and so the relief due is 32.5% of that figure, being £1,950. This reduces the final tax liability to £8,450. The tax was payable on 1st October 2019. That leaves the final 2 repayments, being £12,000 made during the year ended 31st December 2019 and £14,000 during the year ended 31st December 2020. These are shown on the slide in orange and purple respectively. The repayments give rise to refunds of Section 455 tax which are receivable by reference to the accounting period during which the repayment was made. So the £14,000 repayment made during the year ended 31st December 2020 gives rise to a refund of Section 455 tax of £4,550. This will be received by the company on or after 1st October 2021, being the due date for that period. I mentioned earlier that not all repayments are treated equally. Provisions are in place to stop arrangements whereby a person repays his or her loan, thus avoiding or reducing a tax charge for the company, only for a replacement loan to be made. Such arrangements are commonly referred to as bed and breakfast arrangements. There are 2 restrictions. The first applies where a replacement loan is made within 30 days of the repayment, and the second where, at the time the repayment is made, arrangements are in place for a new loan to be made in the future. Both are subject to a de minimis amount as shown on the slide. Where either restriction applies, the repayment is matched with the new loan, leaving the original loan within the charge to tax. Importantly, neither restriction can apply where the repayment is such that it gives rise to a charge to income tax for the borrower. A good example of this is where a dividend is credited to the shareholder's loan account with the company, reducing or extinguishing his or her debt to the company. A loan made during the period should be declared in supplementary pages CT 600A to the company's tax return. Where the repayment has been made before the end of the period, relief is given in calculating the chargeable amount and should be shown in the tax computations. You should complete box A5 of the supplementary pages CT 600A to indicate that a repayment has been made. You should complete Part 2 of the supplementary pages CT 600A to claim relief for a repayment made after the year end and before the due date. A claim for the refund of tax paid earlier should be made using Form LP2. There is a link to this in your notes. The due date for claiming a repayment is 4 years from the end of the financial year in which the repayment was made. We've already discussed one of the main consequences for the company of writing off a loan, that is, relief from or a refund of Section 455 tax. But there are other consequences to consider. In writing off the loan, the company will create an expense in its P&L. This expense is not allowable in calculating the company's corporation tax liability. Also, where the participator is on the payroll, the amount written off is earnings for NIC's purposes. This will give rise to an NIC's liability for the company and for the individual to be accounted for through PAYE. The participator is deemed to have received a dividend equal to the amount written off. This is taxed in the same way and at the same rates as any other dividend. Therefore, for a higher rate taxpayer who has used their dividend allowance, the tax charge will be equal to 32.5% of the loan. Where the participator is on the payroll, the amount written off is earnings for NIC's purposes, and so will give rise to an NIC's liability for the individual. The key things to remember from this module are, firstly, the rules are quite widely drafted, applying to informal as well as formal arrangements. Secondly, the tax charge is reduced, or tax paid earlier is refunded when the loan is repaid. However, care should be taken to ensure the repayment is effective given the potential application of the rules to prevent bed and breakfasting. Thirdly, the tax is payable through the company's tax return using pages CT 600A. Where a refund of tax is due, this must be claimed. And finally, there are a number of consequences of writing off a loan for the company and for the participator. In particular, the participator is deemed to have received a dividend equal to the amount written off. I trust you found this module on loans to participators informative. Please exit this activity and click Launch Quiz to complete the quiz. Once you've completed the quiz, you'll be able to print out your personal certificate. The module homepage also contains a link to the notes that accompany this module and to further resources available to you from Croner I. Goodbye, and thank you for using Croner I eCPD.
For further information and to view the full range of Croner I eCPD modules, visit our website at croneri.co.uk.